Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoen here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
All right, Steve, let's jump into our first topic today. The Bank of Canada's decision to cut its rate by 0.25%, bringing it down to 2.5%. This move was expected by many economists, but the language of the announcement has sparked some interest, especially from Doug Porter, the chief economist at BMO.
That's right, Sandy. Porter mentioned that the bank's cautious language doesn't exactly promise more cuts this year, but it doesn't rule them out either. He seems to think they'll hold off in October, cut in December, and then again in March. It's all about how the data unfolds in the next 6 weeks, which is a pretty tight window.
It's interesting to see how they're taking a short-term focus, reacting to the data and events as they happen. Penelope Graham from ratehub.ca pointed out that this cut is a response to a slowing economy and a job market that's taking a hit due to tariffs and trade disruptions. She also mentioned that the bank's door is open for more cuts if these economic challenges continue.
Yeah, and that's where the inflation numbers come into play. Inflation rose slightly to 1.9% in August. The bank's not entirely comfortable with this outlook, which is why they're being cautious. But with the U.S. Federal Reserve also cutting its rate, it gives the Bank of Canada a bit more flexibility. The Fed's move could ease some pressure off the Canadian dollar, allowing the bank to potentially make more cuts without as much concern.
Penelope also highlighted that this rate cut will lower variable rate mortgage costs. For example, the best 5-year variable rate will decrease, widening the gap between it and the 5-year fixed rate. This could be attractive for those who are more price-sensitive, though it always depends on the borrower's risk tolerance.
That's a good point, Sandy. The Government of Canada 5-year bond yield, which is used by lenders to price 5-year fixed mortgage rates, has stayed in the 2.6 to low 2.7% range. Some lenders have already dropped their fixed rates, and more might follow if yields continue to align with this dovish sentiment from the central bank.
Exactly. And Penelope gave an example of how this impacts homeowners in Alberta. With a 25 basis point decrease in their mortgage rate, a homeowner could see their monthly payment drop by $63, saving $756 annually. It shows how these rate changes can directly affect mortgage costs.
It's a significant saving, especially in today's economy where every dollar counts. It'll be interesting to see how this plays out over the next few months, especially with the Bank of Canada's next meeting coming up in just 6 weeks.
So, Steve, we're seeing some positive signs for Canadian homebuyers as affordability improved in most major markets in July. ratehub.ca's latest affordability report shows that 12 out of 13 major markets experienced relief, thanks to falling home prices and lower mortgage rates.
That's right, Sandy. It's a welcome change for buyers who've been struggling with high costs and tight credit. The average 5-year fixed mortgage rate dropped from 4.8% in June to 4.4% in July, while the mortgage stress test rate eased to 6.4%. This means households need less income to qualify for a mortgage, which is great news for markets like Toronto, Vancouver, and Hamilton.
Absolutely, Steve. In Toronto, for instance, the required income to purchase the average home fell by $4,040 to $200,800. Vancouver buyers saw a similar trend, needing $3,100 less than the previous month. However, there was an exception. St. John's didn't see this relief, with buyers needing an extra $710 in income due to a $6,600 jump in average home prices.
That's an interesting point, Sandy. It highlights how not all markets are affected equally, and local factors can still sway affordability. The pandemic-era housing boom, driven by record-low borrowing rates, sent demand soaring, but when inflation spiked, the Bank of Canada had to respond with aggressive rate hikes, cooling the market but making mortgages harder to qualify for.
Right, and now we're seeing a shift in the economic climate. Inflation dropped to 1.9% in August 2025, and the Bank of Canada has cut its rate to 2.5% after 7 reductions since June 2024. This has led to lower bond yields and prompted lenders to trim their fixed mortgage offerings. The best 5-year fixed insured rate is now at 3.94%, according to ratehub.ca.
However, the mortgage stress test remains a significant hurdle for many potential buyers. Borrowers have to prove they can handle payments at their contract rate plus 2% or the minimum qualifying rate of 5.25%, whichever is higher. Most are still qualifying at rates above 6%, which could be a barrier despite the improvements.
And looking ahead, July's gains might be temporary. Fixed mortgage rates started rising again in August as bond yields ticked up, with the lowest insured 5-year rate now at 4.04%. But with inflation cooling, there's hope that the Bank of Canada might make further cuts, which could ease borrowing costs if bond yields respond.
It will be interesting to see how this plays out. The key will be watching inflation and how the Bank of Canada responds. If they can strike the right balance, it could mean more sustainable affordability for homebuyers in the near future.
Let's turn our attention to the latest data on housing starts in Canada. The Canada Mortgage and Housing Corporation reported a 10% year-over-year increase in actual housing starts in August, with 22,156 units in Canadian centres with populations of 10,000 or more.
While that sounds promising, there's a bit of a twist. The seasonally adjusted annual rate of housing starts across Canada fell by 16% from July to August 2025, landing at 245,791 units. Kevin Hughes, the deputy chief economist at the CMHC, noted that this decline is significant because it falls below the 6-month trend line.
Right. And Hughes mentioned that if this slowdown continues, it aligns with their forecasts and current market intelligence pointing to a deceleration in housing construction. It's a reflection of decisions made when interest rates were lower and investor confidence was stronger.
Exactly, Sandy. It's crucial to remember that these figures are not just numbers. They represent the market's response to broader economic conditions. With interest rates previously receding, we saw a boost in investor confidence. However, as conditions change, so does the pace of construction.
Looking at specific regions, Vancouver saw a 46% year-over-year increase in housing starts, hitting 3,028 units. This growth was driven by multi-unit and single detached activity. Meanwhile, Montreal posted a 32% rise, with 2,725 starts bolstered by multi-unit construction.
Toronto's numbers, however, remained relatively stable compared to August 2024, with 3,543 starts. Together, Vancouver, Montreal, and Toronto accounted for 42% of total urban starts in August, underscoring their key roles in the national housing landscape.
It's also worth noting that while urban starts showed growth, rural housing starts declined by 4% year-over-year. Despite this, the overall total for all areas of Canada rose by 8% compared to August 2024.
These trends highlight the varied dynamics across different regions and types of housing. As we look forward, it will be interesting to see how these patterns evolve, especially with potential changes in interest rates and economic conditions.
Well, Steve, as we look ahead to 2026, it's clear that mortgage lenders are taking a cautious approach. The recent Bank of Canada interest rate cut has provided some optimism, but economic uncertainty is keeping lenders on their toes.
Absolutely, Sandy. At the recent Canadian Mortgage Summit in Brampton, several leading executives emphasized the need for a prudent strategy. With signals that the Canadian economy might be in a technical recession, lenders are focusing on maintaining stricter guidelines and preserving their current assets.
Sushanta Sen from MCAP highlighted that the recent increase in the unemployment rate is another sign of potential economic strain. This has led lenders to focus on both strengths and weaknesses in different parts of the country, ensuring they navigate these challenging times effectively.
Right, and Nelly Uzbasian from EQ Bank mentioned how regulatory changes have tightened their risk appetite. They're carefully assessing the market to ensure borrowers can make their payments, especially since many people are currently overextended.
Imran Thaver from Optimum Mortgage pointed out the bond market's influence on fixed mortgage rates. While there might be some relief for borrowers in the short term, he believes that rates could rise on the fixed side in the long term, emphasizing the importance of understanding borrowers' risk tolerance.
That's a crucial point, Sandy. In the MIC space, Riaza Ali from Fisgard noted an increase in sub 500 credit scores. This highlights the importance of evaluating borrowers' capacity to repay and managing their debt loads effectively.
Greg Sinclair from Magenta Capital Corporation added that lower beacon scores and higher debt loads are becoming more common in loan applications. He's advocating for brokers to have tough conversations with clients to find suitable solutions, even if it means saying no sometimes.
It's all about finding the right balance, Sandy. As we move towards 2026, lenders and brokers must work together to navigate these challenges, ensuring they provide the best advice and solutions for their clients.
Absolutely, Steve. It's a complex landscape, but with careful planning and collaboration, the industry can continue to support Canadians in achieving their homeownership dreams.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.